Welcome to What the is going on with the economy, the #1 personal finance and economics newsletter for people living abroad, powered by Abroadin. I'm your host, Elliot Locke. Let's get into this week's episode. This week, we're taking a look at what happened with gold, silver, and sometimes digital gold Bitcoin over the past few weeks. We also have our poll to help us decide which workshop to run next, which you can find in the show notes. Let's get to it. First up, I want to talk about buying real estate, especially the decision we have to make about the down payment. Last week, I had a wonderful conversation with a friend who also happens to be one of our early access signups. She lives here in Barcelona, but works remotely for a US company, earning dollars each month. She's been saving diligently in anticipation of buying an apartment here, and recently found a place that both matched her budget and her vision for what her home could look like. She's been keeping a lot of her savings in dollars, as she gets a higher interest rate on the deposit than in euros, but was struggling with how to manage the currency conversion. While we definitely think getting the best rate possible for the down payment is prudent, it's not the most important calculation that goes into buying a piece of property. Our down payment is an opportunity cost, and we have to decide if making it is the best use of our money given all other options. What's more is that we often have to decide how much of a down payment we want to make. In terms of overall interest costs and monthly payments, the bigger the down payment, the less it will cost. However, this calculation ignores the alternative use for our money. What would I gain by investing that excess down payment into the market? And if I did that, what would it cost me in terms of extra interest payments? This is a tough question, especially because we have to think decades down the road. Yet the numbers don't lie. For example, let's say you find an apartment for 300,000 euros. You can get a 25-year mortgage for 3%, and you have 90,000 euros saved up for the down payment. In the country you're living in, you need to put up 20% of the house price as a deposit, meaning you need at least 60,000 euros. Comparing these numbers by themselves, making the bigger down payment is a no-brainer, saving you over 12,500 euros. Looking at the breakdown, a 20% down payment of 60,000 euros leads to a monthly mortgage payment of 1,138 euros, with total interest paid reaching over 101,000 euros. In contrast, a 30% down payment of 90,000 euros drops that monthly payment to 996 euros, and the total interest to 88,753 euros. But buying a home doesn't happen in a vacuum, as you have many other financial needs to worry about. Let's also say you can invest into an ETF that historically earns 8% per year. If you were to forego the additional 30,000 euro down payment and put that money into your investment fund, you'd have 205,000 euros extra, or 192,500 euros after the interest costs of a slightly higher monthly mortgage payment. So in this case, my friend should opt for the lowest payment, right? But because she's earning in a foreign currency, not so fast. As we dove into our conversation, we started thinking long-term about her ongoing costs. Like practically everyone living in Europe and earning dollars, she's all too familiar with the joys and pains of riding the exchange rate roller coaster. With mortgage payments being her biggest cost, it also represents her largest future liability, one that's amplified by currency risk. So we looked at how we could hedge out that risk naturally to ensure she'd have a big enough buffer to ride out big downswings without going over her budget. With some math, we came to the conclusion that making a bigger down payment now to lower her monthly mortgage payments was the far better alternative than making the minimum deposit, paying less interest, and investing the rest in the stock markets. For her, getting that lower monthly payment meant she wouldn't be so impacted in her day-to-day spending and long-term financial goals if the dollar weakened. Even if her mortgage payment would go up in terms of her earned salary in dollars, it wouldn't go up as much as if she had taken a higher one at the cost of a lower down payment. Perversely, it also gives her the peace of mind to continue her long-term wealth-building goals. Since she has more cash after her mortgage payment, she can put that extra bit into the market, funds that wouldn't be available with a higher monthly mortgage. This technique also works the other way around. If the dollar strengthens, she'll pay less mortgage in terms of her earning currency, letting her invest the excess into the markets. It was a great conversation for both of us. She got peace of mind, and I got to dive into these complex questions that really show how complicated these sorts of decisions can become. It was also an opportunity to build out a calculator to help her and many others run these numbers to see for themselves. You can get access to this tool in the link in the show notes. Moving on to precious metals, last week was a rough one for many investors, particularly for those who were riding the recent gold and silver rally. For Bitcoin investors, it was even worse. Here's what happened, what you should know, and why it's important. Let's start by looking at the commodities markets for precious metals. Starting from January of last year, both gold and silver went on a historic climb, breaking numerous records in the process. For gold, many analysts put the rally down to the erratic policy coming out of the Trump administration. Investors traditionally look to gold in times of uncertainty, and with Trump giving almost zero forward guidance through his impulsive leadership style, the original precious metal looked more attractive than ever. Central banks were also big drivers of this rally as they looked for non-dollar assets to fill up their reserves. Analysts, pundits, and gold bugs alike were all convinced that as long as Trump continued to make off-the-cuff policy announcements, then gold's ceiling had no limit. Silver, on the other hand, was a perfect example of a retail rally. While silver does have some historical use as a store of value, the metal has numerous industrial uses, making it less of a safe haven than gold. Instead, individual traders, many of them based in Asia, kept buying the commodity as a bet on its value. As the price increased, so did its demand, leading to a 392% increase in value in just 13 months. We call this phenomenon a melt-up, which is a rapid and unexpected surge in an asset's price with no real economic justification. Then at the very end of January, the party stopped. Looking at silver since the start of 2025, we see a massive vertical climb that suddenly snapped. Starting on Thursday the 29th, gold and silver investors began selling furiously. Suddenly, what looked like a one-way ride upwards was rapidly reversing course. Over the following days, gold dropped nearly 14% from its record highs. Meanwhile, silver fell a staggering 38.85%, brutally punishing those who came late to the party. Investors put gold's fall down to a couple of different factors. For one, investors saw a profit and decided to lock it in. More importantly, economic news out of the U.S., including the nomination of Kevin Warsh to replace Jerome Powell as the head of the U.S. Central Bank, the Federal Reserve, as well as the dollar bouncing back from its mini-crash the week before. Silver, on the other hand, had little to do with the future outlook of the U.S. economy. Instead, the sell-off was a textbook example of a bubble bursting. At one point, a large investor decided that the rally had reached its peak and decided to cash out. Other traders in the market noticed, panicked at the move, and started selling as well. Just like with the melt-up, silver melted down rapidly as investors fled to lock in their gains. The chart for gold shows a similar, though slightly less extreme peak, followed by a sharp downward trend as the market corrected. Meanwhile, everyone's favorite cryptocurrency Bitcoin has been having an adventure of its own. Like gold and silver, Bitcoin also had a mostly productive run in 2025. Trump ran on being the pro-crypto candidate, promising a light-touch regulatory approach to cryptocurrencies and decentralized finance. The market for Bitcoin responded to this well, and despite some hiccups in April around Liberation Day, it too hit an all-time high of over $124,000 in early October of last year. At that time, Bitcoin enthusiasts were riding high, with some lauding the genius of Bitcoin treasury companies like MicroStrategy. Like with gold and silver, though, Bitcoin's rise was in for a rude correction. From its peak on October 7, 2025 until late last week, Bitcoin dropped 49%, closing at just over $70,000 per coin. In many ways, the Bitcoin sell-off mirrored what's been happening with silver. After a huge run-up, many investors decided to cash in on their gains. As investors sell, others follow, accelerating price drops. Additionally, institutional investors are also losing interest, selling Bitcoin ETFs and shares of treasury companies linked to the cryptocurrency. As of this writing, the selling continues, with no bottom in sight. The data shows Bitcoin's value essentially cutting in half over the last few months, losing all the momentum it built during its summer surge. Another angle we're watching is the changing view of what investors think Bitcoin is good for. For the longest time, there was the belief that Bitcoin would be digital gold. Like gold, there's only so much Bitcoin that can be mined. Once that supply is depleted, whatever is left in the market should, in theory, retain its value. In that sense, Bitcoin would make an excellent substitute for gold as a safe place to park money during uncertain times. Throw in the fact that the cryptocurrency is far more portable than physical gold bars, and it's no surprise that many people were hailing Bitcoin as the future of inflation protection. The past 3 months have completely shattered that illusion. While gold and silver kept climbing upwards, until as recently as 2 weeks ago, Bitcoin began its fall before Halloween. At the same time, Bitcoin moved closely with the stock market. For example, when Trump announced his Liberation Day global tariffs in April, Bitcoin fell with the markets while gold and silver both rose. From October, this break with commodities became clear. As Bitcoin fell, gold and silver went up. Comparing the three together, gold and silver show a clear upward correlation, while Bitcoin diverged significantly, trending downward even as the metals reached their final peaks. With that hypothesis broken, crypto investors are likely looking for the next use case to establish a price point. Until they have that, the market will likely continue to sell off. Now for our Industry Season 4 Episode 4 breakdown. This week, the financial jargon hits hard as Tender moves to expand its reach through a high-stakes partnership. Here are the 3 concepts you need to know. First, the wealth offering or tied agent arrangement. Tender is looking to quickly launch a wealth management platform. To do this, they are proposing a tied agent arrangement with Almiraj Pierpoint. The bank would provide the essential brokerage licenses and market access, known as the pipes, while Tender provides the technology and the customer base, known as the platform. Second, CoCo bonds and the 7% trigger. Tender requested a yard, or $1 billion, to seed the project, which Pierpoint will only provide via a contingent convertible or CoCo bond. These are loans that convert or get zeroed out if the borrower's capital ratio hits a specific trigger, in this case, 7%. Unlike standard loans, these can be wiped out instantly if the firm's value drops, similar to the famous Credit Suisse collapse where CoCo holders were completely zeroed out. Third, gross leverage, often called the glass jaw. Harper and Eric are executing their short strategy against Tender with 100% gross leverage. With $250 million in equity and another $250 million borrowed from Goldman Sachs, they have doubled their market exposure. This creates a glass jaw balance sheet because they have no cash buffer. Even a small upward move in the stock price could shatter the fund. The bottom line, in high finance, the sincerity of a new launch is often backstopped by aggressive leverage and high-risk debt triggers. At Abroaden, we help you see through the drama to the actual mechanics of your money. If you'd like to watch the recap, we have the full version on our YouTube. Otherwise, you can check out the 20-second snippets we put up in the form of Reels on Instagram. Finally, some Abroaden news. We're keeping the workshops coming and are gearing up for our next one in a couple of weeks. However, we need your help. Help us decide which one we should do next. We're split between two great topics for our next workshop: how to quickly get on top of your accounts and finances spread around the world, or mastering multi-currency budgeting. Help us decide which one we do first by voting in the quick poll link in the show notes. That's it for this week's edition. Thank you for joining us. Thank you also to our sponsor, Abroaden. If you like what you heard, be sure to subscribe so you never miss out on all of our updates. From the entire team, I wish you a good one, wherever you may call home.